Welcome. I'm back. We're going to take a look at the live press conference with Chairman Powell as soon as it comes in. I thought I'd go ahead and while this is coming up, share with you what the 10-year Treasury is doing and mortgage rates. So I see here that they're just getting ready to go, and hopefully you'll be able to hear what's going on. This brought to you obviously by the Washington Post. It's interesting to look here at the treasuries, how the yields gone down, kind of gone back up, gone down. Mortgage rates are having a fairly decent day, positive, it says. We were 6.79 this morning, or 6.75. Now we're 6.70. And we wait for Chairman Powell to come on and share some little ditties with us. Will this change real estate? Eventually. I saw an interesting economist talking this morning that was explaining just what a tough spot the central bank is in right now, and that they really have no choice going forward after today than to lower rates. I mean, if we have a day where 5 regional banks have problems, he said you could expect them to go down 100 basis points immediately and probably have to stay there for a while. And the dips that we're seeing in houses regionally, he was saying California's down 11% from their high. We're down about the same now. We were down about 15%, but we've gone up about 3%. And he said that downward spiral is going to end. And he says, I don't know how much farther real estate will go up, but if it gets to a certain point, more people will list, because right now they don't want to list. As more people list, that'll take a little bit of pricing pressure off. But again, it's just speculation. And I thought it would be interesting today. It looks like somebody's kind of coming up there and slapping a couple notes on the podium. They always say they're going to start at 2 o'clock Eastern time, and they're always late. So, and you always wonder too, did any news leak out? Here's the rates turn around and going back down again. When they have these meetings, is there anybody that happens to go in the hallway and go, hey, guess what? I heard that he's not going up a quarter of a point. Things happen quickly now. And again, I'm talking about this economist. Hey, Tyler, good to see you. He was saying that one of the things that made these bank runs, especially with the SVB Bank, so fast was Peter Thiel sent out a newsletter to all of his subscribers and said, get your money out. He had a lot of money in there. He worked with a lot of these tech companies that had their money in the bank. And because of Twitter, what would normally take a few days to get out there happened in a matter of hours. And so tweets started going out. Peter Thiel says, get your money out of SVB, run for the hills. And indeed, the big players did. And what happened was they have to get money back to the depositors. And the only way to do that is to sell bonds and treasuries. Well, they're not worth as much as they were when they bought them. So they ended up with this huge loss. And they ended up to where nobody would buy their bonds. They were trying to raise money to give their depositors, and nobody was willing to buy what they were holding. And they didn't have any hedges out there, so they got burned big time. They had a bunch of bad investments too as well. You can always say that about every bank, I guess. I don't know. I'm not a banker. But it sure makes sense. They didn't have anybody that was willing to take on their bonds, and they had a good old-fashioned run on the bank that happened in a matter of hours on a Friday. And so the feds came in, took them over. Also reading, there's like 200 banks out there that could be in the same position. I'm only laying this out there because it's not so much the rate increase that Powell's going to announce today. I want to hear what else he says. Well, we decided to go up 0.25 today. Going forward, we're going to look at this, and this. Last time he was on, they were saying that they were going to be more aggressive for a lot longer. And I think all that's off the table right now. I don't see that happening. Let's see what's going on. Nothing too major there. Everybody's sitting and waiting. Let's see. Nothing's moved there. I'm going to refresh it for just a moment. 6.70. Oh, now it's leaning more towards positive territory than it was. So hopefully you'll hear the volume on this. I think it's going to be pretty decent. So I've done this before. This is the boring part. Waiting and listening to me. I shared this morning on my live stream that, you know what? Real estate's doing fairly well. Despite where rates are, and this other economist that I saw this morning said there are so many people on the sidelines waiting. Investors have pulled out, but they've got money and they're waiting. And there are quite a few people with a lot of money ready to buy that are just sitting on the sidelines waiting for their opportunity. It's kind of in two camps. One, people that feel that the market's going to crash and they're ready to get in whenever that crash happens. I don't see one coming. Or two, just some level of affordability that if rates come down and prices don't go up like crazy, then maybe they can jump in. Maybe that's their opportunity to get in the market. Although you didn't see a lot of that after we came down 15%, there was some when rates got down to where you could get a 5.75 loan. Then they jumped on it. So we do know that rates in the fives will bring people back to the real estate market. We're at about 3,100 units on a 7-day moving average. In fact, if I put up on my ticker here from this morning, you can see that we're only at 14,133 listings. That's about 100 lower than last week. And they usually spring up on Fridays, but they haven't done that yet. It'll go down again tomorrow, probably by about 100 units. And we used to have every 7 days, 4,100 homes come on the market and 4,100 homes go under contract. It was very boring. You just look and go, well, nothing's changed. But then it got to where you'd get 4,100 homes come on the market, 4,600 go under contract. It was more like 4,100 to 4,400. And that was putting on a lot of pricing pressure. Hello, Stephanie. She had read this morning a Fed increase at 0.2. Obviously, it has not been announced by Powell as of yet. And we sit here and wait. And behind the guy with the goofy haircut, some of these government officials, I don't know, maybe he's a journalist, but come on, guys. We're waiting. Tyler says more fun listening to me than the BS on Yahoo. I was going to go to Yahoo. I didn't. I don't know why. I tried to get on YouTube and see who was going to have the easiest thing to follow without. I didn't want to have commentary with other commentary, so that's why I just went with the Washington Post here. They'll broadcast it, and they won't be giving you any any color commentary. So that's what I'm going to try to do. So, but yeah, he hasn't entered the room yet. Everybody's greeting each other. They haven't turned on the sound yet either. So what's the market doing again here? Oh, staying right about the same. So kind of fun to watch the charts. I called this financial theater the other day. Just, something to watch, something to do. And I had a YouTuber tell me that I was real estate theater. Half the time he doesn't like my comments, or what I say. So sometimes you just got to quit complaining. Oil up $1 already, back in the 70s. Lots of green from Wall Street. We don't want oil to go up too much, not before my trip. So that's why I canceled it last year. Oil went up to $6.50 in some of the states, and it added $2,000 to the cost of my projected trip. So I said, no, not going to go. So now I am ready and leaving in about 6 weeks. And so let's keep the gas prices where they need to be. And I also saw, hey, Tyler, you're probably experiencing some of this, but I saw a video this morning of the winds and the tide at the reef in Rocky Point. Now, we really had the bad winds when I was down there a couple weeks ago, but the water is right up to the edge where the RVs park, and it's just splashing up there, which tells me that the reef where you normally sit out on the sand is probably getting battered pretty bad. So it looked pretty rough up there. Stephanie says Bernanke price level targeting protocol, as is espoused recently by Bernanke, may have Fed increase their target rate from 2%, 3 to 4%. Don't see a lot of pricing pressure for them to continue to go up. These got, they have two protocols. They have to keep the banking system sound, and they have to control inflation. And they can't let banking collapse. They can let housing collapse. They don't give a rip about that. It's in fact, it's probably more desirable for them. And Peyton says it was windy this morning, Santan. Yeah, same out here in East Mesa. We had yesterday a tree knocked down a power line and no power for about 5 hours. That's pretty quick for Mexico. Yeah, Tyler, I was in Panama. It has been announced. It's a 2.5 hike. So they announced it before he got out there. Thanks, Jason. Surprise, surprise, right? Well, we know that he went up 2.5, so let's see what he says about that. Tell me in the comments, what do you think he's going to say? Is he going to say, we're going to hold? Or is he going to repeat his aggressive stance? I'm going to say he's going to hold. He says, we're going to be in a watch and see moment. We're going to stay put for a while and look at the data. So that's thank you very much. I'm not taking any questions. Bye-bye. So I meant the inflation rate. Oh, I'm sorry. Yes, Stephanie. Let me put that back up there again here. So yeah, from 2% to 3 to 4. Yeah, there's a lot of chatter about that on the inflation rate. People saying, well, maybe your target should be closer to 4 instead of 2. 2 is pretty doggone aggressive. I don't see them getting there anytime soon. Their food prices are not coming down. They don't count food and fuel in a lot of the prices. Consumer goods, they do. So, and housing's about 30% of that. So you lower rates, housing stabilizes or maybe goes up. There goes your inflation target. Stephanie, again, I think he's going to say target is 3 to 4% inflation, not 2. Some inflation is good. They need some inflation to pay off this historic national debt. Yeah, Tyler, I was going to tell you, I vacationed down in Panama. Actually, I went on a big tour down there. And I don't care where we were, you'd sit there and the lights would go out and then you'd hear a generator pop up and then everybody just went about their business. And you're in your hotel room and power goes out. Oh, then it goes back on. So Tyler says he's going to tell us that he'll keep raising if needed just to keep things down. His words of the future are more powerful than the day it actually happens. Potential threats work wonders. Yeah, and he's better at it than Alan Greenspan. Alan Greenspan was just like a word salad. You have no idea what he was going to say. And when he said it, you just kind of had to go back and go, let me reread this 3-4 more times. He's going to say the banking system is stable. Yes, they always do when things start to crumble. Relax. We've got this covered. We're fine. We're from the government. We're here to help. You got to talk people off the ledge sometimes. So I don't know. See what happens here. So we got 32 of you watching. Fabulous. Where's everybody from? I know that Tyler's down in Ensenada, Mexico. Jason, where are you? Where are you from? And Stephanie, you're in California. I know that. And we do know that Peyton is in Santan. So we did have some people on from Italy and actually Indonesia at one point. So come on, Jerome, you're 15 minutes late for crying out loud. You got people waiting here. I'm just staring at flags. Okay, they announced the 0.25. So what happened? What moved? This doesn't look like it's moved yet. Let me refresh this one, see what's going on. Let's see. Still 6.70. This is a rate survey here. So we got um, Jasper's in Maricopa. Bet you're looking forward to that new road that they're going to be putting in. And YouTube says, guy at the end of Animal House, all is well. Yep. um, Los Angeles, and we have North Phoenix. Welcome, welcome. Jason there says it'll be interesting to see if he mentions the debt ceiling. I'm in Scottsdale. Yeah, the debt ceiling. I mean, they have no choice but to raise that. I mean, they're just trying to pick the right political verbiage before they do. But they've got to raise the debt ceiling. They always threaten that they're not going to, but it's impossible not to do it with all the spending that they've already committed. So, and the alternative would be default. So that would be bad. Tuning in from Phoenix. All right, Pamela, welcome. And we have Seatown in the house. All right. That's north. Are you north central or central? Let's see. Be interesting to see whether the bottom market's already baked in. I think it has, and I think that's kind of what we're seeing here too. Because here's kind of the range right here. I mean, we went up this week, came down, so went right up to 4.07, came down to 3.39. That's a pretty healthy move. And who's that? If you ever watch Meet Kevin, he says he calls him Chairman Pew Pew Pal. And GH here says hello from Maricopa. A lot of people in Maricopa down there. Outstanding. So my phone is buzzing here. Politicians who speak constantly about the debt ceiling usually are clueless about macroeconomics. Stock market rallying because groupthink was the Fed rate was going to holding or going down. Glad to see the Fed wasn't playing chicken with the stock market. Stock market's affected more by Fed policy than it really is anything else out there because it affects earnings. A lot of big corporations right now, because of the higher interest rates, are holding back on their capital spending in the Ray and McQueen area. Oh, okay. I thought you were saying Central Phoenix. Chandler, that's right. Why did I forget that? Rob G, they're going to keep rates higher for another year. Plenty of low-hanging fruit still needs to shake loose. Well, see what he says. If he can do that, without banks, being in trouble, that wouldn't be a bad move for me for real estate if rates stayed right where they're at right now. And I don't mean for me, but I mean for the market in general. I think that would be healthy. I realize that goes against a lot of you that are really hoping the rates come down so you can get in, but we could have this gradual adjustment and a move towards better affordability if we can just find a level where we stay for a prolonged period of time. But we already know that big spikes up and big spikes down in interest rates just cause chaos. And out of chaos, we end up making poor decisions. And when the money was cheap, people jumped in. I mean, one of our viewers out there said he's sitting on a 2.75 or was it a 2.25 interest rate? He's not moving. Don't care what happens to the equity. Stay put. So chairman's trying to figure out, he's erasing some of the words he was going to say and he's putting in new ones. So, but they're all sitting down. So at least they're not wandering around like they were. And this is live. So it's kind of like waiting for the verdict in a jury, right? So coming down just a hair. I don't think what I'm seeing here, the 6.70, I don't think that's going to move. I think that'll move tomorrow. This is what I mostly look at down here. And so this is now, watch this. I'm going to turn off my red ink here. Let's see. Manage extension. Watch this. Turn it off. Turn it back on. Go back to my page. Hit this. Voila. I have a red pen. I have to turn it off. Turn it back on again. So we've got Jesus down there in Gilbert. Welcome, welcome. Jason, how are you, my friend? Jason says, sounds like you are feeling better. I am. Thank you. I had a very irritating cold. It still lingers a little bit. I think I got it from Pat over the phone because he got it over the phone from somebody, and it just stayed right here. It wasn't bad, never got in the chest. It just like one day I got up and I said, "Well, I'm not doing the live stream this morning." I agree it would be healthy for a long-term picture. I'm a broker myself and actually prefer they keep pushing forward. Yeah, stay where you're at. That would be great. I did get notification from one of my best friends lives down in El Paso, and him and his wife both have COVID. And I said, well, good. You got it out of the way before we go to Las Vegas, because we're going to Las Vegas at the end of the month. Gonna watch Journey and Loverboy, not Journey, Foreigner and Loverboy. And I couldn't remember who Loverboy was. And John, he's just jacked for the trip. Oh, it's going to be so much fun. And so I looked up Loverboy, and boy, that lead singer, he's put on a lot of pounds. I mean, they came out like one at a time. First, the keyboard guy starts, then the bass player comes out, then the lead guitar player comes out. And I see this guy lingering in the back. Looks like an overweight stagehand. He's back there kind of shucking and jiving. And all of a sudden, he goes up the micro, and I go, whoa, that guy has changed. So should be fun. It's going to be at oh, what the heck is it? What's that? The place with all the boats. The rains here in Los Angeles have been constant. Raining again today. Go figure. Did you see that big storm in Southern California or Northern California? 118 mile an hour winds. All of their reservoirs there are full. They're overflowing. Every one they have. We are at 87%. And the reason we're draining them now and letting the water out is because the spring runoff really hasn't started yet. And so they're trying to make room for that spring runoff. And then this water that we're releasing actually makes it into our aquifers. So that's good. It's kind of like, you can't say the drought has officially ended, but you can sure say that it's been whacked against the head. I mean, we usually get our rain in the summertime. I feel bad for the spring training people that are here. They flew down to sit out in the lawn and watch baseball and sit on a blanket in 80-degree weather, because that's normally what we have here on the third week of March, but it's just been dismal. And but the good news is, like I showed you this morning, the flowers are in full bloom anywhere you go. You can go up to Sedona. You're not going to see a lot of flowers in Sedona, but if you head out towards Payson, you will. Go up the Bush Highway, which is, if you're going towards Canyon Lake, just head north and go through that little wind up by Saguaro Lake, and you are going to see some great colors. I'm going to try and head up there with a camera, I think, maybe tomorrow. Mesa, welcome. And Stephanie said, I read that if the reservoirs get too full, they can break the dams, which is the reason they have spillways. Absolutely. This is May Washington weather. Yes, well, I don't want the weather to be wet in May when I go up there. I'm leaving here, I think 2nd or 3rd of May. And we have a class reunion that's going to be outside under a tent in Sequim, Washington, Dungeness, actually. And so I don't want it to be cold. Sometimes in May, it can be 80 degrees up there and beautiful. So we'll see what happens. And here, Chairman Powell right now is 23 minutes late. Shame on him. I've been on 23 minutes, 45 seconds, and he is nowhere to be found. Come on. Where are we at here? Went down just a little bit right there in the corner. Looks like it's kind of stuck there for now. This is the one I like. I was going to point out to you. This is what I really pay attention to. Where's the movement? So it's saying it's positive. And just since we've been on, it's gone this way. See that? Now it's not quite so much. And then it's going to go back the other way. So that's kind of moderately stronger, it says. Prices. Where people watch that, and you mortgage brokers out there, I know you're glued to these charts. And you're trying to figure out when you can lock your buyers. And so you're staring at that chart all morning going, well, what's tomorrow? Are we going to want to lock today? Do we want to lock tomorrow? And that's why Barry Habib has so many followers and subscribers, because he goes into great detail every morning. And so it says here, sorry, you're staying in an RV campground in Port Angeles. I got a DHMTB race there in late spring. Oh, where are you going to be racing at? That's what is a MTB race? Um, I grew up in Port Angeles, so I've met a few people out here that mentioned one of my friends out there. He's got a uh, sprint boat racetrack. I don't think he has it anymore, but I was down at the Perch in Chandler and saw these guys, and they go, "Yeah, we're down there with sprint boats." And I said, "Oh, yeah, I got a friend of mine does that in Port Angeles." I had his name. They go, "Are you kidding? We know him." So they send him a text. "Hey, we're sitting here talking to Rick. Downhill mountain bike. Wow. Okay. Well, my knees could never handle that now." So where do you do that up there? Um, so you're going to be driving up. Um, Chairman Powell, still not here. It's called Dry Hill in Port Angeles. I'll have to look for that. Give me something to do while I'm up there. Where is this guy? I'm going to go to Market Watch here for a second and see what they have to say. Fed hikes interest rates again, pencils in only one more increase this year. Huh. Okay. Well, where'd you get that news? We're patiently waiting. So he's saying, I guess, let's see what this says here. Banking woes will impact the economy, but effects are uncertain. Inflation picture worsens slightly. The fact that it worsens at all can't be comforting. They moved ahead with another interest rate hike, saying inflation is now expected to be hotter than they previously thought. The Fed lifted its benchmark federal funds rate by 1/4 percentage point. A year ago, that rate was close to zero. Officials said that the recent stress in the sector would likely lead to tighter credit conditions, reduce economic growth, but the extent of these effects are uncertain. The Fed statement said that some additional policy firming may be appropriate to bring back its 2% target. Doesn't sound like they're moving out of the target. This language replaces a phrasing in previous statements that indicated ongoing increase in the Fed's benchmark rate would be needed. So they will closely monitor incoming information. Yeah, we get that. So let's see. This is do a video from Warden outside of Port Townsend. Oh, interesting. Okay. I'm late. Did you announce yet? Yes. Well, he didn't, but it has come out, Jackie. It's a 1/4 point, and they're saying they're leaving room for one more. The Fed is not projecting any rate cuts this year. Huh. Markets are skeptical. Participants still see the central bank lowering interest rates this year. That's a clear sign investors are worried about a sharp downturn, economists said. The FOMC vote to raise policy interest rates was unanimous. So everybody said, yep, we're going up one more time. But the traders are going, we don't think you're going to keep raising. So as we get into later in spring, in the month of May, that may be when you start seeing mortgage rates coming down. Here we go. Let's see. Make sure he's got some sound going here.
Good afternoon.
I don't hear him. Why
Before
don't we hear
discussing
him?
today's meeting, let me briefly address
My system
recent
sound is
developments in
off.
the banking
Okay.
sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged.
Let me know if you can hear that.
History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system.
Perfect.
These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%.
I'm trying to turn this up.
Appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are
I think you did.
from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay, so, Jason, I've had a few rate improvements based on his comments. I notice he never mentions government fiscal policy multipliers, which combined with Fed monetary policy either increases or decreases. He doesn't seem to say a whole lot about how much money the Treasury is spending. He drops little things, little nuggets here and there, but that's a big problem. There's a lot of money being spent out of Washington, D.C. The Inflation Reduction Act, $1.3 trillion. That's all spending. There's no reduction in that. I realize I'm getting a little political there, but it's still money. To me, and tell me if you think I'm wrong here, he said kind of what we expected he was going to say. He says, well, we're going up 0.25. We're going to watch more. We're probably going to go up one more, maybe. So the market's saying, nope, I think you're done. I think you're done. He also said that the banking, that lending is going to get tighter. But how tight can it get to where they have to reverse and start easing on these rates? And what kind of tightness would that mean? I don't think it would mean that mortgages are going to be harder to get, but it could be where you get a lot of this venture capital money that comes in that they borrow from these regional banks, and that will really clamp down and squeeze down. The other thing that's in the mirror is a lot of commercial real estate now is a lot of these people sign, most commercial real estate is done in 5-year leases. And many businesses that are leasing space are going to, at the end of that 5 years, probably just give it back. You see some of the buildings here in Phoenix, like the Carvana office, they've got financial problems, so they're subleasing a lot of their space. I think even the State Farm building is subleasing some of their space. And so we're going to get to where we have some real vacancy rate problems in commercial real estate that could cause that sector to get beat up pretty bad. And there won't be a whole lot of lending to build more commercial real estate going forward, I don't think, next year, because they're going to anticipate that. I think Powell just glossed over the banking stuff. He didn't elaborate much on that at all. So I think he's just trying to come out and say, we're still going to get 2%, and we're going to see it in 2025. Could be starting to see it already. So let's see. Let's take a look at these 10-year treasuries again before I get off here. And here's the chart. So it hasn't moved much since his announcement. The Fed this year, the Mortgage News Daily hasn't moved much. It says one of the most important, interesting Fed days in a long time. And I didn't want to stick around for a lot of his questions, but let's see if there's any more headlines that come in from Market Watch. Nope. Industrial is already the only thing really doing good. It is here in Phoenix. I mean, there's a lot of new industrial building going on out there, but some of these office buildings and stuff, I think they're going to take a hit the next couple of years. Tyler says if he does in fact leave rates, it'll take a long time to get below 3%, meaning everyone with the rate buy downs are going to be in a world of shat when they renew in a couple of years, in my opinion. We could speculate about this all day, but I don't see him in a position to hold these rates here much longer as we've got all this shakiness in the financial system. So it's going to be an interesting time. Thank you, everybody, for joining me. I just decided 2 minutes before he went live to get there. Sorry, Jackie. Yeah. Office buildings already taking a hit. They are. I agree. I decided 2 minutes before he came on, oh, shoot, I think I'll go live. We'll see how fast I can whip this up. So turns out I could have really taken my time. Everybody have a great day. I will see you tomorrow evening with the gang at 6 o'clock. Take care.